Cool. Okay, so I think probably about time to get started then. So today I'm talking about 10 ways that we can preserve and increase liquidity during these challenging times. I'm sure you've all heard it far too many times. Your ears have been talked off by the news, news and media, just about everything that's going on. You can see I'm here in my house at the moment. Tried to make it a bit appealing for everybody that's watching. We're obviously all on lockdown. It's a very uncertain time at the moment. People are losing jobs, unfortunately, and I hope everybody that is watching is healthy, safe, and well. So I'm just going to talk to you very briefly about how we at Enness can potentially help you with bridging some gaps, using some mortgage finance and potentially some other things as well. So just to begin, I'm just going to go straight into it. So I've got, apologies if I look down, I've got some notes in front of me that I'm going to use to jog my memory. So to begin, remortgaging onto better rates. So as many of you may have seen, the Bank of England has slashed their base rate to 0.1%. This is completely unprecedented. It's a historic low. And many of you may be thinking that this is going to reflect in mortgage rates. You are somewhat correct. The mortgage rates don't necessarily follow the Bank of England base rate directly. However, it does mean that mortgage rates will soften. So if, for example, you're on a pretty hefty interest rate at the moment with your current mortgage, it may be beneficial for you to contact us at Enness or even have a look around online just to see what's potentially out there for you. You could reduce that interest rate. So currently we're looking at some products out there which allow you to remortgage onto variable rates, and then in the future potentially remortgage those or change those rates back onto fixed rates, and thus taking advantage of these slashed interest rates, as many of the lenders' interest rates do follow or track the Bank of England base rate fairly loosely. When we're talking about high value loans, which is what we tend to deal with at Enness, in the 6 and 7 figures, these small fractions in interest rates can make a huge difference to your monthly payments and can free up a lot of liquidity, helping you in these uncertain times when potentially income isn't quite as hefty as it once was. Apologies. Moving on from that, we're talking about you may have heard of interest-only mortgages and also capital and interest repayment mortgages. So obviously with a capital and interest repayment mortgage, what you're doing is your monthly payments are paying the interest as well as the balance of the mortgage down. So each month you're paying that mortgage down. Eventually, when you get to the end of your term, you'll have a zero balance on your mortgage. What you can potentially do, and what we're looking at now with some of our clients, is moving them from the capital and interest onto the interest only. And in that sense, every month you're just paying the interest of that balance, and therefore making your monthly payments significantly reduced. This just frees up a bit of cash in the meantime during this time, and then you could potentially move back onto that interest, the capital and interest repayments, and continue to pay that loan down. There are obviously benefits to both. There are downsides to both as well. The interest only obviously offers decreased monthly payments, increasing your monthly cash flow. Like I said, you can always switch back, and it does allow you that in that increased liquidity that you have and better cash flow, you could potentially take advantage of other investments that are coming up during these uncertain times, as well as bridging some gaps in your reduced finance during these times. So number 3, which is something that many of you have probably heard in the news, is payment holidays on your mortgage. So the government has basically announced financial backing for lots of banks to encourage these payment holidays. Now, this is on all residential, buy-to-let and commercial mortgages. Some lenders may not offer it and you may not personally qualify for these, but it's absolutely worth calling up your lender and asking. We've had a lot of clients, myself personally had a lot of clients call me asking if it's something they can do. And I've actually heard of banks pretty much just saying, as I'm sure you're probably aware, these banks have got fairly hefty waiting times on their phone lines at the moment. And so rather than having a conversation on the phone and saying, yes, we'll put your name down and we'll give you a call back later to discuss your new payment plan. Of course, there are conditions attached. It's not free money. You will still be charged interest on the months that you are on holiday from payments, but you will not be making payments for those months. This does mean that when you go back to making payments on your mortgage payments will be slightly increased as a result of the fact that you have taken a holiday from this. So you do just have to be aware that it isn't free, and you will have to make it up in the long term. Of course, if a bank is putting pressure on a client now and forcing them to pay a mortgage they can't afford, and in such they default, it's just going to cost that bank money in the long term. So it's within a bank's best interest or a lender's best interest to make sure that they offer you the flexibility. Otherwise, they're just going to end up paying through the nose for that sort of thing. And of course, not having to pay a mortgage, I'd imagine this is the majority of people's outgoings each month if you have a mortgage. It just means that you're allowed to, it allows you to shore up some liquidity, potentially pay some other bills, or help with a business in these times, that sort of thing. So moving on from payment holidays, going on to talk about capital raising. So essentially what this is remortgaging your current mortgage or putting a mortgage on a property that doesn't have a mortgage, and raising a bit of capital on top of that. Sorry about that. And raising a bit of capital on top of that, and essentially giving you some cash in your bank account to use in the short term. Now, a lot of banks do have strict criteria on what you can actually do with this cash, whether it's buy another property, put it into paying for things, business loans, all that sort of thing. I've heard of some lenders maybe relaxing this criteria in this kind of climate as a result of people being out of work and all that sort of thing. If you can afford to increase your loan size on your property, it's potentially a good way to get a good little boost of liquidity into your bank account, and help when cash flow is an issue. Especially looking at mortgage rates at the moment, like I said previously, with the Bank of England base rate being reduced to 0.1%, it does mean that there are some incredibly favourable rates out there, meaning that it's quite a cost-efficient way of getting this liquidity boost that you might potentially need. As well as this, we do see a lot of our clients being high net worth individuals, ultra high net worth individuals. A lot of these people are very asset rich, and potentially their assets don't have liabilities on them. So they've got this asset sitting around, maybe cash flow is down as a result of the current climate. You could potentially utilize that asset to release some cash back to you, just in the short term to like I say, bridge some gaps, help an ailing business, all that sort of thing. And it just introduces a buffer between your financial assets, liquidity, and your liabilities. The opportunities to capital raising may come from potential rises in property value. As many of you may have known or seen in the last decade or so, property prices have been rising pretty dramatically, and therefore you may have a mortgage on that, but the equity in your property has increased quite significantly, which may just allow you to increase the loan to value on your property and release that money back to you. So moving on from capital raising, I just want to talk a bit about offsets. So some of you may have heard about offset products. Essentially, this is where the interest rate is offset, or the balance is offset against savings that you hold in an account with that lender. There are some pretty phenomenal interest rates out there for this sort of product. I recently organised some finance for a client of mine using an offset product. And essentially, it allows you to use your savings in a time when interest rates are low, which is obviously, it's 0.1% is fantastic for borrowing, but it's not so great for your savings. They're obviously not accruing all that much interest while they're sat in a savings account. So one way that you can absolutely use your savings to assist your financial situation is to offset your mortgage against that. And it essentially just means that the balance is offset against the savings, and you pay interest on the difference. in many of these products, the savings actually aren't locked either. So it's not like if you have a few £100,000 stashed away in a bank account, in a savings account with this offset product, that you can't touch those savings and use them if needed. But of course, as you reduce the savings, the efficiency of the product reduces in itself, and obviously the interest rate charged on the balance is increased in line with those reductions. So it's obviously beneficial to maintain a high level of savings in the account. That's quite a small sort of point, but it can be very effective. Like I say, I helped a client with this recently, and it was incredibly beneficial for them in the current climate with their own personal business potentially suffering as a result of recent situations. So last few ones. So we've got the next one I want to talk about is a product transfer. So some of you may be on long-term fixed rates, fixed probably 3 years ago, 5 years ago, potentially if you're on a 10-year fixed rate, even further back than that, meaning that you could be on quite a hefty interest rate. A product transfer is essentially moving to a different product with the same lender that you currently have. And like I say, again, I'm going to talk about it a lot because it's big news at the moment, but the Bank of England having cut interest rates does mean that mortgage interest rates have softened, the mortgage market has softened. As such, many lenders are releasing products now with pretty crazy low interest rates. So it might be worth having a look just to see what your current lender is offering, and see if you're eligible for moving that product over. The increase in competition has meant that many of these lenders are offering even better terms than may have been seen previously when you set up your original mortgage. And potentially now you have even more assets or collateral that you could bring to the deal to help with the terms and conditions of the new product. Of course, it's one of the bank's best interests to maintain you as a client, because gaining new business always costs more than maintaining current clients. So I'd like to think that lots of these lenders would do what they can to help you out with moving across to a more favourable interest rate, especially considering the current economic situation. In the same sort of vein and on a different point together, further advances and second charges. This is a very small niche corner of the mortgage market. They're essentially a similar, same sort of thing, but a little bit different. So a further advance is an additional bit of lending on top of your current mortgage with the same lender. It's a change in the terms of conditions, and potentially a new interest rate. A second charge is a same but different thing. So it's additional lending that sits behind your current mortgage from a different lender. And again, we'll have a separate interest rate to your first product. But it just allows you, in the same way that a capital raise, if you have that increased equity in your property, it just allows you to utilize that and potentially get some lending on that. They're pretty good in the short to mid-term. Interest rates, of course, tend to be just a little bit higher than first charge mortgage, but that's as a result of the increased risk to the lender in having a charge sat behind your first charge mortgage. Again, this is likely the increase equity in your property is likely due to either paying off your first charge mortgage down to a level that's increased equity in the property, increased property prices, that sort of thing, or maybe even just having a low loan to value mortgage in the first instance. And of course, the new interest rate, like I said, will be different. But once again, the interest rates at the moment are staggeringly low. So it could be a pretty efficient way of releasing a bit of capital from your property and increasing your liquidity during low cash flow times. Now, moving on to the last three, they're slightly different to a standard mortgage. So the next one I want to talk about is lending against liquid or near liquid assets. So what we're talking about here is stocks, shares, that sort of thing. So as many of you may have seen, many of you may be following the current stock market. It's been pretty dire recently. I haven't seen it today, I'm afraid, so I can't report on it today. But it does seem like it's on the up, which means that you probably don't want to sell any of your portfolio of stocks and shares, should you have any. But you could potentially utilize that by lending against those assets, and releasing that capital from those assets while also maintaining them. As I'm sure will happen in the very near future, they'll look to rise again, and regain the value that they once had. Now, the one thing to consider with this is loan to values tend to be fairly lowish, depending on the volatility of the product. So obviously that's the volatility of the asset. So if the asset is highly volatile, then loan to value is obviously going to be kept low to try and mitigate the risk. But again, with this kind of thing, the interest rates are very favourable. There are some banks out there that are offering some fantastic interest rates on this kind of product, and of course it's relatively low-ish risk to a bank if they can take hold of some fairly liquid assets that they can liquidate fairly quickly. Should anything happen, the worst come to worst, and you can't make the payments on the loan. Now, just briefly moving on to another form of finance, I'd like to talk about bridging finance. So many of you may have already heard of bridging finance. It's sometimes a bit of a buzzword in the financial industry, especially the mortgage industry. And essentially it's short to mid-term finance that's secured against either assets, future sales proceeds, or future cash injections, for example, pensions, or the realization of shares and all that sort of thing. As a result of it being secured directly against these assets, or this cash, there's very little in the way of due diligence and affordability and all that sort of thing, as a result of the fact that it is a loan to value against the guaranteed value of the asset. Because of this, they're very quick to draw down. So you can draw down in a matter of days, or even a couple of weeks. Loan to values tend to be a bit lower than a standard mortgage. Interest rates, as a result of the risk in the short term, and also the very high flexibility of these products, it tends to be a little bit higher than a standard mortgage. But these don't tend to have early repayment charges. So should this cash injection come after a month or 2 months, you can pay it off without having to pay any penalties. Or if it was to take 6 to 8 months, you could again do the same thing. The terms for these tend to vary from a matter of days to months, sometimes up to 24 months or even longer. But and again, it's a very, very flexible way to increase liquidity, increase cash flow, and potentially help in these uncertain times. The bridging products as well sometimes allow you to roll the interest up. Of course, it's a high risk when it comes to pay off the product at the end, but it does mean that you don't have to service that product in the short term, meaning that you can get the capital, get the increased liquidity, and not have to worry about paying it back in the short term while cash flow is potentially low. Now, moving on to the final point, this is something that we encounter quite a bit or a little bit at Enness, is alternative asset lending. Now, many of you may know Enness as a mortgage brokerage, which is what the majority of our business is, a majority of what we spend our time doing. However, we do have some fantastic relationships and connections with some lenders who can offer lending against some alternative assets, and this can be anything from cars, classic or modern, boats, art, planes, wine, jewelry, anything with a value. The likelihood is that we can find some lending against it. Lenders may ask for different levels of security against these assets. Of course, the different markets have different volatility, so loan to values may be different as well within all this sort of thing. But it does mean that should you have a classic car that's really dear to your heart, or a boat that you love using that you've had for years, art that's hanging in your house, that sort of thing, it means that you don't have to look at selling it. You can still have it, but you can just release a bit of the equity or the capital from that to utilize in this time when cash flow might be low. And that capital can be used for anything, for, like I said, businesses, bridging funding gaps, helping family members out, anything like that. It can kind of be used for. Now, a lot of these things, of course, the asset that you're securing the funding against could potentially be at risk. This goes for everything from property, cars, boats, planes, whatever. The asset could potentially be at risk should you not keep up the payments to the finance. But of course, hopefully that won't happen, and hopefully in the next few months we should see markets becoming a bit more buoyant, and hopefully all of this settling down a bit more, and all of us coming out of lockdown. So just to conclude, those are my 10 points. So the key is basically to utilize income available, and also the assets to hand. So basically seeing what you have, seeing what your current income is, and seeing how myself or any of my other colleagues and brokers at Enness can potentially help you. Also doing maybe a bit of research yourself, speaking to your lender, all that sort of thing. There isn't really ever a one-size-fits-all kind of case with this sort of thing. At Enness, we are experts. We're specialists in finding flexible solutions for pretty complex financial situations. So if you have any questions at all, please feel free to reach out. You can get hold of us by going to our website, ns.co.uk. You can contact me directly. So my name is Sam, and you can catch me on sam@ns.co.uk. Enness spelled like this. And I'm happy to put you in touch with any of my colleagues. Also, if you've dealt with a broker at Enness before, please do get in contact with them if you have any questions. Everybody is working from home. Everybody is working to the capacity that they were before this whole lockdown. So, so please feel free to reach out. Now, I can see that we do have a few Q&A questions. So let me see if I can figure out how to use this. Right, so we've got a question here about lending against luxury cars. In regards to the lender who lends against luxury cars, would the client still be able to use the car, or would it be locked away by the lender? Thanks. So actually, we have some pretty good relationships with some fantastic lenders who lend against classic cars, modern racing cars, you name it, they've lent against it. Obviously, they have limits in terms of the lowest sort of car value they can go to. But in most cases, these lenders, what they can do is they'll put a tracker on the car, and they'll allow you to use it while you've got the lending against it. Like I said, that the whole thing, the whole point of this is that we want you to be able to use your assets, like your art, jewelry, cars, boats, whatever, but to utilize them to allow you to increase your cash flow. So the lenders that we tend to use tend to allow you to keep hold of them, unless it's exceptional circumstances, in which case they may have to put it into bonded storage. Right, next one down. Can you refinance buy-to-let mortgages too? Absolutely, yes we can. Yeah, we do everything from residential, that's owner-occupied and buy-to-let, also commercial. We do business loans, which is something else. I mean, the title of this was 10 ways to increase liquidity, but I could have gone on for quite a few more. So we can help with business loans. Done that quite a bit myself. We can do any sort of lending. I'm sure we could help you out with. If you do have any questions specific to buy-to-let mortgages, sam@ns.co.uk. Shameless plug, I'm afraid. How quickly do these liquidity options take to secure? It's a good question. So they vary from product to product. So Bridging finance, like I said, it can be a matter of days to a few weeks. Potentially, if it's really complex, it could take a little bit longer. But like I said, it's a smaller application for that kind of thing. Alternative assets, cars, planes, boats, all that sort of thing, that can be pretty quick as well. I was talking to a good friend of mine who does some lending against classic cars, and they said that they managed to sort out some funding against a 6-figure Ferrari in a matter of, I think it was about 4 or 5 days. But that's assuming you can get the valuations done, of course. In the current climate, the issue is that a lot of surveyors are unable to get to properties and assets to value them. So I think currently that's what will slow things down. However, I have been hearing about some lenders using some desktop valuations, all this sort of thing, and there's a lot of software out there now that allows people to look at markets and that kind of stuff to estimate values. I hope that answers your question. Anyway, if not, sam@enness.co.uk. Right. Mandana has a question. Hi there, for remortgaging, will a valuation be required and do valuations take place? Right, so it's a good follow on from my previous answer there. So it really depends. Again, this is case by case, lender by lender. We've been seeing recently, and things are changing so quickly at the moment, you know, where we are today is a completely different environment to where we were this time last week, or even at the end of last week. We're getting emails and calls from lenders who are saying they can still lend on remortgages and some purchases as well, emergency purchases. And of course, evaluation does need to take place in most cases. Now, up to a certain loan to value, a lot of these lenders are considering they can do a desktop valuation or even potentially a drive-by valuation. Some lenders are saying that they can use, like I was talking about before, software that looks at markets, trends, all this sort of thing to do valuations as well. Again, it's a high risk to the lender, so the likelihood is they'll probably do reduced loan to values. But to answer your question, there are valuers that are still doing valuations. Some of them have some quite strict criteria on whether the property has to be unoccupied, all this sort of stuff. If you have any specific questions on that, a specific scenario, get in touch. sam@enness.co.uk. Right, next one, anonymous attendee. Hi Sam, if I want to take out a further advance on my residential home on top of my current mortgage, will the lender look at my affordability again? The quick answer is yes. If you're taking out a larger loan, they will need to look at your affordability, because essentially, if they didn't, they could give you any sum of money and it would be at a risk to them that you couldn't afford to pay it back. So yes, they will do. If you are needing to raise a bit of capital on your property, and further advance is the way to go, further advances are looked on fairly favourably by lenders. Like I say, they want to maintain your business. They want to keep you as a client. They don't want you to move away. So if they can offer you a further advance at a good interest rate with a, you know, stressed at a fairly low level, that's in their own to their own benefit. They don't want you going to a second charge lender and looking at them. They'll try and do what they can within their means to offer you what you need. I hope that answers your question. If not, sam@enness.co.uk. Usman has a question. If no valuations are happening, then how will you remortgage? So like I say, valuations are happening. It's just happening in a different way. So desktop drive-bys, software. In exceptional circumstances, we are still seeing surveyors go to visit properties. These might be unoccupied properties anyway, so the surveyors are at a lower risk to catching this virus or transmitting virus to other people. So it's difficult to answer, but to answer your question, that valuations are happening. It might be very tricky to remortgage a property up to 90%, for example, because a lender will most likely want to go and visit that property in person. But say you're remortgaging 50, 60%, the potential is that we could find a lender for you that's doing desktop or technological valuations. But yeah, and like I said, in exceptional circumstances, we can potentially find a surveyor to go out. And a lot of lenders have a panel of surveyors that they will only speak to. We're seeing that in light of the current situation, a lot of these lenders are relaxing their panels. And so, for example, we have quite good connections with some very well-known surveyors who are more than happy to go out and see properties subject to certain circumstances. Again, hope that answers your question. Jason, we have a range of commercial and residential mortgages. Can they all be grouped together and the whole be put under one mortgage? Interesting. To be honest, I'm actually unsure on that one. In terms of, I do know that in terms of residential mortgages, you can, it depends what the properties are used for, of course, but you in theory, you can have one product secured against a number of different properties. Commercial, I'm not a commercial broker, I'm afraid, so I can refer you on to some esteemed colleagues of mine to answer some questions on that. If you have specific scenarios or properties or anything like that, please do get in contact. Either call the main line and one of my colleagues will pick up, or send it direct to me at sam@enness.co.uk. Cool. Okay, so I think that is all of the questions answered that are in here. I hope I've not missed anybody out or my computer's being really slow, but that looks to be about some of it. So, so yeah, just in summary, thank you very much for logging in. Sorry for my ramblings. I hope it's been useful to some of you. If you do have any questions, please do get in contact. Enness is spelled like this, E-N-N-E-S. We source finance around the world for properties and all sorts of assets. So if you have any questions, please do get in contact. My email address is sam@enness.co.uk. Alternatively, please go on the website and call that main line, or send an email to info@enness.co.uk, and it will be sent across to the relevant broker. Like I said, I'm not a commercial broker, but any commercial questions, please do send them through to me or info@, and I'll forward them across to some of my fantastic colleagues, many of whom I hope are watching. Anyway, thanks very much, and I hope you tune in for the next one. I'm not too sure who's giving that one, but tune in on the next one. Thanks.